Welcome to The Explainer. Today, we're putting on our data detective hats and turning our magnifying glass straight towards CSX. Now, if you follow the logistics and railroad sectors at all, you know CSX is an absolute behemoth. But today, we aren't just looking at the trains on the tracks, you know? We're diving deep into the numbers in the spreadsheets. I am so thrilled to walk you through this because we are going to uncover the real story hiding right behind the raw financial metrics. We're going to look at the good, the bad, and honestly, the outright surprising. Okay, let's dive right into this. 527.11%. Just let that massive number sink in for a second. This represents CSX's staggering 10-year return. I mean, if you had parked your money in this stock a decade ago, you've experienced absolute blockbuster growth. It's exactly the kind of shiny number that immediately hooks investors and just makes them want to hit that buy button.
So here is the data detective journey we're about to take. 1. The long-term performance. 2. Profitability and dividends. 3. The revenue and cash divide. 4. Valuation multiples explained. And 5. The final fair value.
Section 1. The long-term performance, the glossy surface. It's literally just a sea of green. The recent year-to-date return sits at a very healthy 26.37%. But it's not just some random recent spike, right? Over a 3-year period, we're seeing a 48.97% return. Over 5 years, almost 46%. And then, of course, there's that massive 10-year return of over 527% again. This historical trend is basically a magnet for capital. It tells this incredibly compelling story of a company that has consistently rewarded its shareholders year in and year out. Section 2. Profitability and dividends, the solid foundation. Let's pop the hood and look at the engine because the operational wins here are truly fantastic. First off, 21 consecutive yearly dividend increases. That is over 2 decades of management actively deciding to put more cash into the pockets of their shareholders through thick and thin. Backing that up is a phenomenal 22.47% return on equity, which shows us they're highly efficient at generating profits from the money shareholders have invested. And with a net profit margin of 21.44%, they're keeping a really healthy chunk of every single dollar that comes through the door. Honestly, this looks like an incredibly solid cash-generating machine. And you know, that dividend story gets even better when you check out the payout ratio, which is sitting at just 32.52%. What that means is, despite raising their dividend for 21 straight years, they are still only paying out about a third of their earnings to do so. The remaining 67.48% is retained, so they have this huge cushion and plenty of room for future dividend growth or just reinvesting back into the business itself. Section 3. The revenue and cash divide, the plot twist. Now, what's really interesting about this is, well, hold on to your hats, because here is where we hit the plot twist. Look at the stark juxtaposition happening right now. On one hand, the stock price is totally soaring, up 26.37% year-to-date. But on the other hand, look at the 3-year free cash flow compound annual growth rate. It's negative 16.95%. So the price of the stock is flying high, but the actual lifeblood of the business, the free cash flow, is shrinking pretty significantly. Let's look a little closer at that contraction, because now we are looking at a sea of red for recent growth. Over the last 3 years, revenue hasn't just stalled out, it's actually contracted by 2.24% annually. Net income is dropping by 10.68% a year, and as we just saw, free cash flow is absolutely plunging by nearly 17% a year. So despite the stock climbing up to near 52-week highs, the actual real money coming in the door is currently shrinking across the board. Which naturally brings us to this absolutely critical question. How is the stock climbing while cash flow shrinks? This is the core mystery of our data detective work today. When the stock price disconnects from fundamental growth like this, it usually means investors are paying higher and higher premiums, basically hoping that the future is going to magically reverse the trends of the present. Section 4. Valuation multiples explained. So, the crucial point is exactly how expensive the stock has become. The current price to earnings, or PE ratio, is 28.01, but the company's own 3-year historical average is only 20.86. Investors are currently paying a 34% premium for the stock compared to what they were actually willing to pay on average over the last 3 years. You're basically paying way more for a slice of the pie, even though the pie itself is currently getting smaller. Let's see how this builds when we look at the actual cash. The price to free cash flow multiple is even more drastic. Right now, it sits at a staggering 44.65, which is well above its 3-year average of 33.11. This makes it crystal clear. Buyers are currently paying top dollar an absolutely massive premium for less actual cash generation. And if you want a metric that really flashes a bright red warning sign, just look at the PEG ratio. The PEG ratio attempts to balance the stock's PE ratio against its growth rate. Normally, you want to see a low positive number. But CSX's PEG ratio is currently negative 11.70. Why? Well, because the earnings growth itself is negative. When growth turns negative, traditional valuation models literally start to break down and warp. It's a loud mathematical alarm bell going off. Section 5. The final fair value. Okay, so we've seen the legendary past, the incredibly solid margins, the shrinking current cash flows, and those highly inflated multiples. So what is the stock actually worth? To answer this, we look at the discounted cash flow, or DCF model. This model is great because it strips away all the market hype and stock market momentum. It simply looks at the actual cash the business is expected to generate and discounts it back to today's dollars. It's kind of the ultimate truth teller in finance. And this brilliantly illustrates the massive gap we've been hunting for. The last closing price of the stock was $45.66. But according to the strict discounted cash flow math based on the source data, the fair value price is only $26.75. That is a massive cavern between what the market is currently paying, which is mostly driven by past reputation, and what the actual underlying cash flows say the business is worth today. Which leads directly to our final punchline, a margin of safety of negative 70.67%. In value investing, a margin of safety is your buffer, right? It's your protection against being wrong. A negative 70% margin of safety means there's absolutely zero buffer. Based strictly on DCF metrics and the current free cash flow trends we just looked at, the stock is highly overvalued right now. You are paying a premium for growth that, according to the 3-year data, simply isn't happening. And that leaves us with this final provocative thought to really ponder. Does a legendary past justify a premium price for a shrinking present? Look, CSX is undeniably a great company with fantastic long-term returns, incredible margins, and literally decades of dividend reliability. But right now, the numbers clearly show you're paying top dollar while revenue and cash flow are heading in the wrong direction. Can momentum carry it further, or will gravity inevitably pull the price back down to its fundamental fair value? Think on that as you review your own notes. Thank you so much for joining me on this explainer, and remember, keep asking the right questions about the data.